Hey everyone. Welcome to my channel. If you're new to investing and want to make passive income and accumulate wealth through investing, this video is for you. I am going to teach you everything that I learned from working at Wall Street as an investment banker and investment professional. This is not a video that recommends specific stocks, but rather I will teach you how to find good stocks and make money. I will include example and step-by-step guide. Let's dive right in. Step number 1, identifying attractive stocks. There are lots of good stocks out there in every sector, not just big tech stocks like Apple, Amazon, Microsoft, etc. So don't feel like you can only make money by investing in big tech stocks. For example, financial stocks like Ares, KKR, Blackstone, and Apollo outperformed these big tech companies over the past 5 years. You just need to remember all good stocks have a few things in common: strong fundamentals, such as steady revenue growth, profit margin improvement, positive cash flow, strong management team, leading market share position, consistently beating earnings, strong historical stock appreciation, and future growth prospects. Now that you have found the stocks you want to invest, you can move to step number 2, which is determining whether the stock is undervalued or overvalued currently. There are essentially 2 ways to determine whether the stock is undervalued or overvalued. The first approach is relative value, which you compare the stock's valuation multiple, such as PE ratio and EV to EBITDA multiple, to peers and competitors. If your company's ratios are lower, then it would imply the stock is cheap, on a relative basis. To make it easier for you to understand, it's like buying a house. When you buy a house in a certain neighborhood, you want to know how much did your neighbor pay for their houses, assuming that all the houses in this neighborhood have similar size and features and are built at the same time. If all your neighbors purchased their new 4 bedrooms, 5,000 sq ft house between $1 million and $1.2 million, and the house you are looking to purchase is $900,000, it's considered cheap and undervalued. To illustrate this with a real example by looking at the forward PE ratio of alternative asset managers. Given the target company's multiple of 15x is less than the 19.9x median multiple, the target stock is considered cheap on a relative basis. To find valuation multiples, you can go to Yahoo Finance, or you calculate yourself by looking at company's annual report, 10K. Your trading platform should also have these valuation multiples. If you don't know how these multiples work or how to calculate them, leave a comment below and I will make another video for that. The second approach is intrinsic value, which measures the true value of a stock by looking at the company's future cash flows and discounting them back to today's value. It's also referred as the discounted cash flow analysis. To calculate the intrinsic value, you need to develop a financial projection for the company and discount these cash flows back to today's value by using an appropriate discount rate that reflects the risk profile of this company. While it is not a complex analysis, it does require you have some finance background and basic understanding of a few concepts such as time value money, cost of capital, terminal value, etc. Let me illustrate with an example. Here we have a simplified 5 years cash flow projection model for Nike, using high-level assumptions that mirror the company's historical performance. One thing to note is that Nike's revenue growth is slowing down and EBITDA margin has been declining. So it is safe to assume similar margin and growth rate for the next 5 years. I am assuming a discount rate of 10%, which is the company's cost of capital and reflects the risk profile of Nike. Since we already project out the future cash flow for the next 5 years, all we need to do is discount them back to today's value using the 10% cost of capital. The present value of these cash flow is $18.3 billion. We also need to do the same for the terminal value, which captures the value of a business beyond the 5 years projection period. Because publicly traded companies are expected to last forever, but it is impossible to forecast cash flow forever. So the terminal value assumes the business will generate cash flows at a constant rate forever. Usually, for U.S. companies, the 10-year Treasury yield is a good proxy for terminal growth rate. You can refer to the exact formula here to calculate terminal value. Once we have the terminal value, we discount it back to today's value, which is $68.9 billion. We then sum up the present value of all the cash flows, which gives us an enterprise value of $87 billion. Because Nike has $8.9 billion debt and $9.8 billion cash, the implied equity value is $88 billion. Which is less than the current market cap of $114 billion. What this tells us is that Nike is overvalued by the market for 29%, assuming these assumptions such as growth rate and margin are correct. We can also cross-check using a relative value analysis that we talked about. If you look at the comps or peer groups, Nike is currently trading above the median multiple in terms PE and EV to EBITDA. In conclusion, we can say Nike is overvalued not only just on a relative basis but also in terms of intrinsic value. Just to recap, we talked about how to find high-quality stocks, and how to determine whether the stock is cheap or expensive. Next, we will cover when to sell, since you will only make money when you sell the stock. When to sell a stock really depends on your personal objective. Let's say you buy the stock at $20 and 1 year later it is $26, or 30% return. Is this a good price to sell? Well, if your objective to generate 15% return on this stock, then you achieved your objective and it's okay to sell. You can also rerun the valuation analyses we talked about using the company's latest financial information to see whether the stock is over or undervalued currently, and then make a decision. You should not feel bad if you sell the stock and the stock continues to go up. As long as you make money, it's already a win. Last but not least, investing is a long-term game. If you are not planning to buy and hold the stock for more than 1 year, you are basically trading, not investing, which is fine as there are lots of successful traders out there making millions. If you like this video, please hit the like button and subscribe. Feel free to leave comments down below and I will respond to your questions. Happy investing!